Yeah, I appreciate folks for joining in today. Today, we want to talk about the energy and sort of carbon offset outlook for 2022, 2023. I do want to thank Paige Lampman, who's helped out with preparing this presentation today. She's an undergraduate, just graduated from OSU, undergraduate in our environment, economy, development, and sustainability major. So let's just move right into it and talk through some of the different energy issues that we're going to be facing in the coming year. So first off, I don't think it's any surprise to people that gasoline prices have been going up. Maybe it's a big surprise, but it's certainly something we're all quite aware of on a daily basis. And I guess the big question is how long are these prices going to go up? They've really tripled since their low in April of 2020, back at the very beginning of the pandemic. And if you look at over the last 30 years, this is the strongest and quickest price increase we've seen over that time period. These are nominal prices, so they're not corrected for inflation. But in any event, you can see that this is one of the biggest and strongest stretches of price increases that we've ever faced. And that's, of course, driven by a couple of different things. First is the big reduction that we had with the pandemic, and followed by the big increase in demand that happened after sort of the first flush of closures with the pandemic. So in that summer, last summer or summer of 2020, I should say. But that was also coupled with some slower than anticipated increases in output by OPEC and others. So OPEC, as well as the US, curtailed their output as the pandemic started, and that output didn't come back quite that quickly. And so that led to a big increase in prices in this early period. And of course, later on, starting here in this year, the big increase in prices has been driven by the sort of unfolding events in Russia and Ukraine. So the question is, of course, is how long are prices going to go up? And to think about that, we have to look at oil, because oil prices and gasoline prices are, of course, really closely tied together. Oil is a global price, and by that I mean that oil prices tend to fluctuate together across space over time. And so here I've sort of plotted out the Brent North Sea price. So this is the price of oil in northern, United Kingdom, as well as the Russian euro price, which is a price in Europe. And these prices have trended together. Of course, they've detrended in the last 3 to 4 months as there's been a significant devaluation of the Russian euro price. So that's oil coming out of Russia. So as a consequence of the sanctions imposed on Russia with respect to purchasing products coming out of there, there's been a significant devaluation of Russian oil relative to other oil prices. But typically, oil prices fluctuate pretty closely together no matter where oil is sold in the world, sort of differing only by quality characteristics and maybe some transportation differences. So as we think to the future and we ask the question, what's going to happen to oil prices in the future, we have to think of both the demand side and the supply side, because both are going to have really critical effects. And looking into the future, we don't have a crystal ball on either of them, so we just have to sort of make some speculations, I guess. On the demand side, the big question that's out there is what's going to happen with recession in the US, Europe, or China? Could that put a dent in this sort of fast evolving and fast increasing set of prices for global oil? On the supply side, there's still a lot of uncertainty about how sanctions are going to affect Russian oil supply. So oil has already sort of, from Russia, included this sort of 20 to 30% reduction in price. That means that people can buy it at a steep discount. So that's kept people in the market for purchasing Russian oil. But at the same time, the question is over the long run, maybe the bigger question for Russia isn't so much this devaluation of Russian oil, but the effect of the sanctions on capital investments in Russia to keep producing the high levels of oil that they actually produce. So we'll find that that's kind of a bigger, longer term question. And then there's a question of what's holding back production in the US and OPEC, both of which have expanded production since the pandemic, but not at the rates, and they haven't gotten back up to the levels of production that we saw about 5 years ago, despite the fact that oil prices are at much higher levels. So those are some questions we have to ask on the demand and supply side. Now on the demand side, when I look at this and sort of think about it and look around at the different organizations that make projections of future economic growth, all of them right now are cutting their economic forecast for growth this year. So the IMF cut their global growth forecast for 2022 from 4.4% per year to 3.6% per year. They're really expecting inflation to have a big effect, and that growth in China and India are both going to be expected to slow in the next year, and that Russia will experience a contraction in their economic activity, all of which is really going to drag down global economic growth. The Federal Reserve followed right along and suggested that US growth would probably slow down or wouldn't expand as quickly as they had thought last year at this time. So they sort of pushed their expectations, their growth expectations for 2022 from 4.0% to 2.8% in March. They just sort of revised their projection down. The Conference Board did the same thing, revised their projection down for 2022. They weren't quite as optimistic as the Federal Reserve, but had about the same level of a reduction in growth expectations. So another issue to think about is rising interest rates and the impact that they could have on capital deployment, particularly in the energy sector. That's more of a supply side issue, but sort of driven by the same factor, rising interest rates that could push the US and other countries into a recession in the future. So there's lots of concerns about that. Obviously, we don't have information on what's actually going to happen. Wish we did. But nonetheless, there is concern that the global economy could be experiencing some slowdown this year and next year. On the supply side, we have to look at and see where the supply of oil is coming in the world. The US is the world's biggest supplier of oil at 15% of the total supply. Russia, about the second biggest supplier at 13%, that is at least prior to this year. And Saudi Arabia, the third biggest at about 12%. Those three combined supply, 43% of the world's oil. And the rest comes from a range of other suppliers, with the next sort of six having an almost 30% share, and the remaining 50 or 60 producers having about 32% of the world's share of oil production. So obviously having an impact on Russia, something that could have an impact on Russia, can have a big effect on global oil production. Supply already appears to be down in Russia by about 1 million barrels per day. That's about 10% of their supply and about 1% of the world's supply. So it's a significant impact on world energy supply in a fairly short period of time. Most of their oil is still selling on existing contracts, but future oil is selling on steep discounts right now. And as we can see, countries and companies are picking up that oil and seeing that discount rate, they're still picking up that oil. So we haven't seen massive declines yet in Russian supply, but there is deep concern that as the conflict continues to unfold there and as sanctions continue to bite, that investments in future production could really lag behind and could have a big effect on the future of the relatively robust oil sector in Russia. Another issue is what's going on in the US and in other OPEC countries. So what you can see is there's the big supply reduction that happened with the pandemic here in 2020. Most countries did respond with increasing output after that, but not significantly increasing output after the pandemic. That's despite the fact that oil prices are at significantly higher levels. So here we are out in 21, 22 with significantly higher prices for oil, higher prices than they were back in this period, and we have lower levels of production. So we haven't seen as big of an increase in production in many places as we would like to have seen. So that is creating a problem. Now, the IEA suggests that US, Saudi Arabia, other countries still have room to expand, and that they'll probably do that in the next few months. And that if they're able to expand their production back to sort of pre-pandemic levels, then that would seriously stabilize prices in the long run. Of course, we don't have an idea as to what exactly the factors are slowing down the expansion of this in those countries. In the US, we have a feeling it has to do with maybe some labor supply issues in the drilling sector, but it could be other things as well. So what are some of the key limitations on the future oil supply growth? OPEC already has a supply gap of around 1 million barrels per day. So this is the idea that OPEC has, as an organization, has strategically set supply amounts that countries, or production amounts that countries can meet, production quotas, but those countries haven't so far met those quotas. So they've been increasing those since the lows of the pandemic. They've been steadily increasing those quotas over time, but a number of countries haven't actually met those quotas yet, and that's having an effect on oil prices. So to the extent those countries can start to meet some of their quotas and get back up to the levels of production that they had pre-pandemic, that would certainly help and limit some of future supply growth. But it's Angola, Nigeria. Those are actually two countries that have big supply gaps, and the reasons there probably don't have a lot to do with political concerns, but probably more to do with supply concerns and the ability to get capital in to start producing oil again, as well as labor at those oil wells. Sanctions on Russia can further lower Russian output. This is kind of that long run issue, and this question about what's going to happen with investments in Russia and how that could affect future oil supply. It's a big concern thinking out 5 and 10 years in the future. And the US is not deploying resources aggressively as it was 8 to 10 years ago. So let's look at that. So US oil and natural gas rig deployment is rising. So this is the number of rigs in the 6 or 7 basins in the US that produce the bulk of the oil in the US. The Permian Basin in Western Texas and Eastern New Mexico is the biggest producing region in the US in terms of oil and has the biggest rig count. You can see huge fluctuations in 2014 when oil prices fell the first time, saw a big reduction in the deployment of rigs in the Permian Basin, a big reduction in oil output at that time as well. But those rigs came back pretty rapidly as prices started to rise again, 2016, 2017, et cetera, and came up to a pretty high level. And this is kind of the period in which the US achieved its maximum oil production. Of course, in the pandemic, those rigs sort of left the market as well and got down to the same sort of low level. They've been slowly coming back, but not quite as rapid of a pace. And despite the fact that oil prices have much more rapidly risen recently than they did during this period. Of course, in the other basins, we've seen much slower deployment of wells as well. So, the big question is why is this? Why are we seeing fewer rigs being deployed now despite the higher prices? And the concern there is that it's still some of the same labor issues that we have experienced throughout the restructuring of the economy in the post-pandemic period are affecting the sector. It might also be capital limitations, which probably will get worse as interest rates rise, right? Making it more difficult to find, capital to deploy, money to deploy into the rigs. And so you put those two things together, finding difficulty of finding capital to purchase the rigs and get the metal, et cetera, et cetera. And don't forget this industry does use a lot of metal, and those prices have risen quite dramatically as well. So there's also high variable costs associated with oil development as well. So those things are really sort of probably having a big effect on the amount of production that we're going to see in the U.S. There are some other factors. So in the Bakken region, that's an interesting region. Historically, they flared off most of the natural gas that was being produced along with the oil, because they didn't have the infrastructure to pull that natural gas into or to recover it and use it in markets. But as the U.S. has pushed towards reducing the carbon footprint of the oil sector and other sectors related to the oil sector, there's been a big effort to try to cap and keep and capture the methane that's produced in the Bakken in particular associated with the oil. So there's been a lot of effort into that, and that's slowed down probably some of the production of oil wells in the Bakken region, as a lot of additional effort has gone into recovering natural gas there. And indeed, we've seen that natural gas outputs from the Bakken have increased much more rapidly than the oil outputs in the last couple of years. There's also concern that this is a maturing formation, not necessarily that output will decline anytime soon, but that we're not going to see the big increases in output that we saw in the early years as the Bakken formation was first exploited in the early 2000s through the 2014, 2016 period. So the outlook for oil, summer demand probably is going to keep pressure on prices over the next several months. My speculation is that prices are probably going to peak in the July to September period at $5 per gallon. In Ohio, on average, that's an increase of 10 to 15% from today. So we're probably still likely to see increases over the next 3 to 4 to 6 months. There is one uncertainty associated with that. The releases from the Strategic Petroleum Reserve are going to start hitting the market here soon. And that could affect prices. 1 million barrels per day for 180 days, I believe, is what the administration has said they're going to use so far. That could start to have an effect. That's the biggest release from the Strategic Oil Reserve that we would have ever had if that comes to fruition. So it's a significant impact. And remember, 1 million barrels per day is kind of where Russia, in terms of their lost supply output as of today, where it is today. So this is kind of a replacement for that. Of course, the question is you can't keep hitting the Strategic Petroleum Reserve like that infinitely. So the question is how long this reduction from Russia is going to last, and whether or not we turn the corner there in the next 6 to 8 months. A midterm demand outlook is less optimistic as these recession concerns start to build. With rising interest rates, U.S. demand growth slowing down. China is easing lockdown restrictions, so that could boost economic growth. As far as we can tell, OPEC is watching this situation. They don't want, they're enjoying high prices right now. So far, They haven't detected that high prices have affected demand dramatically or have affected and pushed countries into recession yet, but for sure they're looking at that situation. My guess is we're going to see this continued high prices for a while, and eventually, if history is any indicator, OPEC will overplay their hand and we'll have limited output a little too much, and at some point we'll be in a recession and prices will fall pretty dramatically. I don't know where that point is, probably 2 to 3 years out. In the longer run, electric cars are going to slow demand growth in the OECD. We've already seen that, actually. So here's kind of the longer term consideration is what's happening with these electric cars. So electric cars, look at the bottom slide here first, or the bottom picture first. Electric car registrations have dramatically increased, mostly in Europe and mostly in China, but the US saw a big increase just in the last year, actually, a doubling of the demand and the deployment of electric cars or registrations of electric cars in the US. They're now about 9% of market share. So they're significant and increasing share of global market share for new car purchases. We've seen in the US and the other OECD countries that gasoline consumption or oil consumption has started to fall, and it started to fall as a result of efficiency gains from the cars we do drive that use gasoline, as well as more recently from the effect of electric cars, the penetration of electric cars. So this trend is probably going to continue. Now in the non-OECD countries, the mostly developing countries, obviously there's a strong trend upward in terms of oil consumption. That's probably likely to continue. We saw a bigger dip in the pandemic in oil consumption in developed countries, OECD countries, than we did in developing countries. So that again is indicating some ability of countries like ours in Europe and other OECD countries to significantly reduce oil consumption without having other huge effects in the economy. Seems like it's a bit harder for other countries, especially the non-OECD countries, to do that, and suggesting that they're probably a little bit more susceptible to oil shocks themselves, right? So one would expect that there will be some increasing price growth in the future, but that ultimately electric cars are going to slow that. Now, how far out that is, that's a big question, right? Probably 5 to 10 years before that starts to have a massive impact. But nonetheless, we're starting to see the impact already. On the other hand, the other thing that has happened is that the growth in global proved reserves has slowed in the last decade. So despite high prices, we've seen a slowdown in proved reserves, suggesting that many of the companies that are out there that would be expanding reserves are sort of looking at this market and asking the question, is oil what I want to be in? And they're probably spending a lot less effort looking for oil, even despite the high prices, given that there's a lot of concern about climate change and a lot of concern about what the value of those reserves will be in the future if the world does suddenly put a global price on carbon. Capital expenditures in exploration and production have slowed over the last decade. It's kind of in line with the idea that many companies now are sort of strategically looking at what they're putting their resources and their exploration in, and starting to move some of those capital expenditures away from the oil sector into the other energy sectors. Then, of course, how much will sanctions affect output in Russia over the longer run? All right, so switching over to natural gas. Again, prices have gone up for that. The question is how much higher are prices going to go? Now, what we've seen is that there's two different price series on here. One is the IMF Global Price Index, and that's this hatched line. And then the US Henry Hub price is the dark black line. Those two lines have tended to fluctuate together, but they do from time to time fluctuate separately from each other. And this is one of those periods where they are fluctuating separately. So the IMF Global Index, which is driven heavily by what's going on in Europe and in Asia, we've seen steep increases in prices for natural gas. Now, a big reason for that is that unlike oil, natural gas, while it is traded globally, is much more difficult to trade globally. So basically, in order to trade natural gas globally, it either has to travel via a pipeline, which can be expensive to put together, or it has to travel by as liquefied natural gas in a tanker, and that's a pretty expensive proposition as well, and raises the cost of sending natural gas from one place to another. So it's not as widely traded as oil. So only 24% of the total natural gas production is traded globally versus 52% in the oil sector. So this means that we can have big price differences much more easily in the natural gas sector than we can in the oil sector. So we're seeing a big price difference here in Europe, largely because, of course, Europe is heavily tied to natural gas coming out of Europe. And the concern there is that natural gas is going to be cut off by the Europeans or cut off by the Russians, or that the Europeans will decide that they just simply don't want the natural gas. So it's a big issue. Most of this price increase globally is really a function of allocation and not supply. So at the moment, there's plenty of supply of natural gas, but the question is allocation of it. And as Russia decides whether or not to turn off natural gas supplies into Europe and redirect some of those natural gas supplies to Asia, that will continue to have bigger price effects in both places, really potentially increasing prices in Europe and potentially reducing them in Asia. So just another point on natural gas trade flows. The US exports about 15% of our natural gas production, about half of which is now exported via LNG, and the other half exported via pipeline to Mexico and to Canada. But LNG exports are going to Europe, Africa, and to South America. Europe imports 60 to 65% of their natural gas, so they are huge importers, with more than 50% of that from Russia and the other independent states, former Soviet Union states in this area of the world. So a big importer in Europe, and obviously that's a big reason why their prices have increased so much. Now, can the US export more? There's a lot of discussion about whether the US could export significantly more into Europe. And the issue there is they really can't at the moment. These LNG export terminals are really big, capital expenditures, costly to develop, costly to implement. For sure, we'll probably see more of them get into the planning phase and get built in the next few years, but it takes time for that to be built. Here we can see the build out in LNG export amounts from 2016 to 2022. And we have increased our LNG export capacity dramatically over that time period. But Europe doesn't need 14 billion cubic feet per day. They need 60 to 70 to 100 billion cubic feet per day. And that's a big ask to push our export capacity up that high. Can other places in the world do it? Well, they say that face some of the same constraints. They face some of the same constraints in the fact that Qatar has big exporting and LNG exporting potential, but they also have to build new supply terminals. Besides that, there's the question of regasification. When the LNG gets to Europe and Europe doesn't have enough capacity for regasification at the time, there is the potential for these floating regasification terminals. So big boats out in sea simply do the regasification process, and that's possible. There's something like 30 to 35 of these things somewhere in the world today, but all of them are already deployed. So someone has to build new ones. This all just takes a bit of time. So there is potential for Europe to quickly, or I shouldn't say quickly, but to expand importing of LNG from other places. But this is not a short-term fix. This is a long-term fix, to the question of their dependence on Russian natural gas. And it will take time to work itself out. It's not something we can do overnight. However, the US has been drilling more, has been increasing drilling. What's interesting in terms of natural gas is that our natural gas production, while it was affected by the pandemic, was not as heavily affected as oil production was. And we got right back up on the sort of same growth trend after the pandemic as we had before the pandemic. So the natural gas sector was able to respond a bit differently to, I guess, what happened with the pandemic and the reduction in supplies during the pandemic by getting back to production levels, previous production levels pretty rapidly. So that was a good thing for that sector and helped to keep natural gas prices at a relatively low and stable level. Where is the natural gas going in the US? Well, most of it, I split between 4 different places: the residential sector, commercial sector, industrial sector, and the electricity sector. The electricity sector by far takes the largest amount. Industrial sector, the second largest amount. The electricity sector has been the sector that has increased its use of natural gas the most since 2001. So that big increase in production that we've seen since the early 2000s in terms of natural gas, a big chunk of that has gone straight into production of electricity. So the conversion from coal to natural gas, which has been great for carbon emissions, is what's really helped, or it's the big output, the big beneficiary of the increase in natural gas production has been that sector as well. But the residential sector has increased as well. So places and people who previously maybe used oil for heating purposes have switched to natural gas because of the relatively low prices there. Now, something of interest to folks out there in the farming sector is, of course, what's happened with nitrogen, which is heavily related. We're using natural gas to produce nitrogen or ammonia as both a heat source and as a source of H for the ammonia. And so what we've seen in the ammonia sector is that a big increase in prices there as well. So what's interesting is the ammonia price index, especially here in the US, is that ammonia prices have increased substantially more than natural gas prices have in the US. So ammonia is, it's a derivative basically of natural gas, or often supplied by natural gas. And you would think that the price might sort of fluctuate with natural gas, and it does in a way, but it does mostly with what the international price of natural gas is. So what we're seeing is ammonia prices have risen really steeply, sort of more in line with what the European price for natural gas, the price increase in the European prices for natural gas. So it's more sort of correlated with that than it is correlated with what's happening here in the US. The big reason for that is because ammonia is easier to trade than natural gas. You don't have to freeze it at the same level that you do liquefied natural gas in order to get it to move it from one place to another. So anyways, this has grown really gone up in price dramatically. Now, a good side of this story is that US is now importing only about 16% of its ammonia consumption, which is down dramatically from 35% about a decade ago. So the US is really, as natural gas supplies in the US have increased, we have seen a big increase in the amount of ammonia that's produced here in the US. We're now the third largest producer behind China and Russia. China is by far the largest producer. We're just a little bit behind Russia and just a little bit ahead of India in terms of production. So significant producers. It's easier to trade, so it does follow the international prices for natural gas. Now, an interesting question on ammonia is really the longer run competition for ammonia. And, this is really long run stuff. This probably isn't tomorrow, but this is in the next 5 to 10 years. The hydrogen in ammonia can be used to create electricity or energy via fuel cells or via a power plant. So there's emerging power plant technologies, just like generators that use natural gas or coal, could use ammonia instead. So there is a lot of interest now in creating, these hydrogen fuel cells and hydrogen fuel cell cars. In fact, California has a number of, has a market for hydrogen fuel cell cars. So basically the hydrogen fuel cells are powering batteries that are then powering the car. And there are fill-up stations to put hydrogen back into the car, just like gasoline. So there's a lot of interest now in hydrogen as a potential fuel for the future. And that ammonia is a fantastic way to store hydrogen. So hydrogen is really hard to move from place to place, but ammonia is really easy to move from place to place. So there's the issue that H2 can be stored and transported fairly easily via ammonia, and that this might be the fuel of the future. So there's a lot of interest in that, and a lot of people are working on it pretty hard. So this is concept of blue ammonia, which is ammonia that's produced via the traditional sort of Haber-Bosch process, which uses nitrogen from the air, natural gas to heat and produce pressure to put those two things together to create the ammonia. And when you then capture the carbon and store it, you create a carbon-free source of ammonia, which then is a carbon-free source of energy, H2, hydrogen energy. So that's blue ammonia. And it's an interesting option, and there have been some sales of blue ammonia around the world. A couple ships went from Saudi Arabia to Japan, I think recently, where Saudi Arabia, produced the blue ammonia, put it in a boat, but then from the heat that it used to produce the blue ammonia, it was able to capture that in deep geological formations, and it sent the ammonia to Japan. Japan then had, carbon-free source of energy, basically. Green ammonia is a different thing, and there's a lot more excitement about this one. That is that ammonia that can be produced via electrolysis of H2O using renewable energy. So we can create ammonia two ways. One is free nitrogen from the air. Another way is the free nitrogen from the air plus the H coming from water. But we use renewable energy for that rather than natural gas. That's green ammonia. So that's also a carbon-free source of energy. So there's a lot of interest in those two things. I'm only mentioning those because in the long run, that is competition for the ammonia. So we could see ammonia prices, if ammonia becomes a fuel source of interest for the energy sector, we could see nitrogen prices in the agricultural sector continuing to test these highs if it becomes a really critical and useful and interesting source of energy in the future, and an interesting source of essentially, carbon-free energy in the future. So just something to think about in the agricultural sector. So where are natural gas prices going in the long run or medium run? The EIA predicts continued upward movement through 2022, up to about $8.59. That's pretty high relative to $2 or $3 that they were, a year or so ago. But May prices have already exceeded their predictions. So, it looks like natural gas has a ways to go in terms of the upswing. However, most people think that kind of skip over the storage thing and come back to that. That most people think that in the longer run that the U.S. Production will continue to expand and expand a bit more quickly and expand by 10 to 15 more percent in the next 2 to 3 years, allowing prices to moderate in the 2023-2024 period. So that this should be sort of, EIA is sort of predicting that these are going to be a relatively short term of high prices. And of course, hopefully we'll have more resolution to the situation in Russia over the longer term as well. And again, the longer term price growth is going to be constrained by the continued expansion of solar and wind. Wind capacity expansions have started to slow down, but solar capacity expansions have continued to grow. So 14% of total generation today, rising to 17% in the next 2 years. So we're seeing big increases in these two sources of energy, which are going to have an effect on natural gas prices in the long run, and start to put a dent in the potential rise of natural gas prices in the longer run. And of course, renewable and storage costs are what set the long-term upper bound for electricity prices. And renewable costs have gone down dramatically. This is according to Lazar's levelized cost of electricity analysis. Unsubsidized wind levelized costs have gone down dramatically. Even more dramatically, there's been a huge reduction in unsubsidized solar costs. And these costs are now lower than natural gas combined cycle, particularly with the high prices for natural gas that we have today, right? So these would be competitive with natural gas in the $3 to $4 per million cubic feet range, and we're at $8 right now. So this means that natural gas prices are significantly higher than these. So it basically suggests that there's going to be a lot more interest in solar PV, maybe less so wind because of it's already expanded quite dramatically, and the footprint of that. There's lots of concerns about the footprint of that. Of course, concerns about the solar footprint as well, but there seems to be some potential for that to continue growing. All right, so the U.S. electricity sector, longer run economics are driven by capacity and storage. So the ability to store electricity, as we know, renewables like wind and solar, they can't be stored. They're sort of only there and available when the wind is blowing or the sun is shining. And obviously, many of us need electricity at times, not just when the wind is blowing and not just when the sun is shining. We like to have electricity then. So we've got to figure out ways to store some of that electricity. And those technologies are really coming along reasonably well. They cost between $130 and $300 per megawatt hour. 130 is consistent with sort of one-time use bunker fuel type generators, right? So if someone's bidding on capacity by turning on a generator that uses some of the worst fuels that we have available to them in the middle of summertime when demand is really high, they're going to be charging $100 to $130 per megawatt hour, right? So this storage is in the range of that, right? So we're starting to see storage, while still more expensive than other sorts of capacity in the electricity sector, storage costs are starting to get to the level where they're closing in on competitiveness with some of these other capacity components. So still a lot of build out that needs to be done in order to make storage a reality, but we're seeing places like California really expand capacity in the storage area, and that's going to continue to sort of drive down costs in the future as well, one would expect. All right, so last section is to talk about climate policy and carbon offsets. So just a couple more slides here about those. The first issue is just to get a concept of what is carbon neutrality or net zero. That's when CO2 emissions are balanced across space by basically CO2 removals. So this is an example of the US greenhouse gas emissions and sinks. So US gross emissions are 6558 billion tons, 6,558 billion tons of carbon dioxide per year. We have this sink, which is about 800 billion tons of carbon dioxide per year. So our net emission is 5769. So, about 800 million of these gross emissions up here are netted out by this sink, and those could be considered carbon neutral emissions. Obviously, the question is who gets to capture those, right? That's a big billion-dollar question, I guess. But nonetheless, some of the US emissions, about 10% of the US gross emissions, are currently carbon neutral, all right? Now, these carbon offsets are generated when carbon is removed from the atmosphere by photosynthesis or by emission reductions from avoided losses, for example, deforestation. If there's an avoided deforestation event, then that would be an avoided loss and would be an emission reduction. So often these are considered in the forest, agricultural soils sectors, methane reduction from animals, as well as reduced fertilizers in corn crops mainly. This carbon offset market has been around for a long time. I have prices going back to 2008. The market itself was established back in the early 2000s, even 2001, 2002. Chicago Climate Exchange was one early participant, but there was an active voluntary market then as well. Price information is not as easily as available, so we don't go back that far with prices. Prices started out relatively high here because there was a lot of excitement back in 2008, 2009 about the possibility of a cap and trade program. When that sort of fell through the cracks and disappeared, these carbon offset prices fell pretty dramatically through 2016, 2017. But as companies in the US and around the world, and as the Paris Agreement sort of took hold and entire countries started to take on bigger climate commitments, we saw the price of these carbon offsets start to rise. It's like risen as of 2021 back to about $6 per ton carbon dioxide. Now this year they've come up a bit more. They've actually almost doubled in price in these voluntary markets to around $11 per ton. California has a non-voluntary market, and forest-based offsets there are worth about $18 per ton. So we're seeing some increases in prices for some of these voluntary carbon-based offsets. And the reason for that is pretty straightforward. The prices have risen as more companies have taken on these net zero commitments, and they're starting to test that market. There's a whole other market out there which uses many of the same types of permits, the aviation offsets, so the so-called Carbon Offsetting and Reduction Scheme for International Aviation, or CORSIA. It's in its pilots phase. We see that the value of those offsets is about $5 per ton, so a little less than this voluntary market. I think the reason for that is this is an exploratory sort of pilot phase where it's significantly voluntary for the airlines to participate in it, and only flights to certain countries or between certain country pairs are sort of covered by this. And in that kind of a context, the number, the supply of offsets is pretty large. There's a big potential supply and a relatively modest demand. That's probably to keep prices low, just to get airlines comfortable in this first few years of pilot phase, to get them comfortable with the idea that they would be sort of offsetting their emissions and learning how to use the system. In any event, the big action here is in the voluntary market, where we are seeing some increases in prices. Of course, the question is where are we going with these prices? How much higher can they go? A recent report by Bloomberg suggested that they could go up by 3,000%. In particular, if the rules are set so stringently that any of these land-based renewable products aren't included. So, it's possible to offset carbon by taking it out of the atmosphere directly, taking it out of the air directly. Direct air capture is what it's called, and then sticking that carbon somewhere. It's also expensive to do that. One can take it out of the flue gases from a natural gas power plant or a coal burning power plant, and then store it underground, maybe in a carbon capture and storage situation. All of these things are relatively expensive. And if society decides that that's the only kind of an offset it wants to use, then Bloomberg might be right, because those technologies are expensive and we haven't seen big price declines in those technologies yet. However, if society decides it wants to allow avoided deforestation, afforestation, and soil carbon, if society can figure out how to get around some of these concerns about additionality, leakage, and permanence, which have been around for a long time, we know a lot about and have some good ideas about how to manage, there is a lot of carbon available in the land-based sort of offsetting sector. A recent study estimated 4.9 billion tons per year available for less than $50 per ton. So that would mean a four times increase in prices, or 5 times increase relative to today, maybe over the next 10 to 15 years. And that supply could increase to more than 11.4 billion tons for $100 per ton. So if we're willing to pay a little bit more, or a lot more, I should say, then that price could increase, or that amount that's available could increase a lot. So it suggests that there's a big supply of this stuff. It amounts to 13 to 29% of the total emissions. And a Green Biz report just suggested that about 80% of the world's emissions are now sort of under some sort of a net zero pledge. So I don't think we'd see a 3,000% increase in prices, but we for sure could see a 3 to 4 to 500% increase in prices if all these net zero pledges are really pushed forward by companies, right? So with that, I think I'm going to end. The expectations of these prices is that we probably, because most of these net zero goals won't be promoted until sometime beyond 2030. So I don't think offset prices in the next year or two are going to rise much above $20 per ton. After that, though, we could see some sort of 1 to 2% per year increases. That is providing that some of the cheapest options are allowed. That is the land-based options. So with that, I'll close it down and open it up for any questions.
Thanks very much, Brent. As always, a very lot of coverage there of the issues relating to both energy prices, where we're going with energy. The stuff about ammonia was really interesting. I didn't realize that you could use it as in terms of energy production. Anyways, we have a few questions in the Q&A. First of these is from Aurea Rivera. The question is, the advancement of battery technologies have provided a market opportunity. However, batteries must be charged. As we described oil, what is the profile for natural gas? So I'm assuming that means what impact does battery charging, use of electric cars have on natural gas usage? I think that's what the question is, Brent. Mate, if Aurea wants to clarify a question, just go ahead and put that in the Q&A box. But anyway, does that make sense, Brent?
Well, it does. One of the things about battery technologies is that not all the batteries are lithium batteries. So battery technology or storage technology is probably better described as storage technology than battery technology. Battery technology or storage technology right now is, at least at the industrial scale, can be thermal. So a lot of processes right now are using, so if you look out in the West, in the Western US, we have some of these sort of thermal solar power stations where they direct the sunlight. So through, so sunlight comes down, it directs off a bunch of mirrors to a central station. And what it's doing is heating up, it's basically heating up a salt solution. And then that salt solution is used to run a generator. So it's basically using the heat from that to run a generator. You could do the same thing with other kinds of electricity. So you can create electricity using solar power the other way, right? And heat up a solution, a solution of salt or some other kind of solution, a briny solution, which will maintain the heat. And then you use it when you don't have as much sunlight or don't have as much of the wind power, et cetera, right? So there's other ways. Other people are experimenting with air, using air and stuffing it into caverns, right? So compressed air, basically. And so you stuff it into a cavern, you sort of hold it in there, and when you need electricity, you release the air and generate electricity that way. So there's lots of other storage technologies that are sort of emerging that have potential and that could drive down the cost of storage. So some of it's going to be battery storage, just like lithium batteries, vanadium batteries, other kinds of things like that. But there's lots of other storage. And of course, another one we already know a lot about is basically just pumping water up and then releasing water from that stored area uphill and releasing it downhill to generate electricity, sort of the tried and true way through, the same way we've done hydroelectricity for years and years and years. So battery technologies are certainly getting better, and storage technologies are getting better as well. And that will help limit the upside on both oil and natural gas, but that's a 5 to 10 to 15 year sort of time frame for those to have a big effect.
Okay, well, I guess you did understand Aurea's question. So now I have a question for you about cryptocurrency. Now, no, it's not a question asking you to explain how cryptocurrency markets work.
Yeah.
The question is, and this is from an anonymous attendee, How will cryptocurrency mining, I guess this is the use of computing power through supercomputers, this whole blockchain stuff, how's that going to affect electricity and energy usage in general?
Well, yeah, I don't think anyone expects electricity usage to slow down anytime in the future, and the demand for that's going to continue to increase. And that a big driver of that could be cryptocurrencies, it could be crypto mining, et cetera, et cetera. And we've already seen that's been a big increase in certain places. Of course, some countries like China have taken a hard line on that, right? And they have really limited the amount of that can happen in that particular place. Lots of other countries have decided not to do that. So, crypto will certainly be a demand factor that's pushing the demand for electricity in the future to higher levels. The expectation is, though, is that increasingly we're going to see that demand being met with renewables rather than non-renewables. And I mean, the issue there is the cost, right? That it's just that the cost of renewables has fallen so dramatically that it just is going to make more and more sense to be deploying renewables, that capital is going to be moving into that sector rather than into natural gas and coal in particular in the future, just because it's cheaper. And it's just reinforced by high price periods like we're experiencing today, which drive up the cost of natural gas electricity relative to renewable electricity.
Okay, I'll come back to the follow-up question that anonymous attendee had. I have a question from Bailey Everhart. Do we expect more states to follow California with a mandatory carbon market instead of a voluntary market?
I personally wouldn't think there will be too many additional states. A good example is like Oregon, right, which has tried to do that multiple times and it's had trouble getting it to the legislature for all kinds of reasons. At one point, I think the Republicans walked out, as Republicans and Democrats have done in different states, right? So, I mean, it's difficult for any one state to do that. What's more likely, well, what has happened is California is linked up with, I guess, British Columbia, with Quebec, other provinces in Canada, and maybe with other countries to sort of try to harmonize prices in some way, shape, or form, or allow trading to happen across regions a little more effectively. So I don't expect to see a lot more states doing that. What I more or less expect is that we're going to run out this experiment for another decade or so with respect to voluntary commitments by companies, and there's going to be an enormous amount of government and consumer pressure on those companies to make good on those commitments. And my guess is we're going to see where we stand in about a decade with those. And then we may revisit the issue of whether we have actual regulations in place. I mean, there might be some regulation. We might get a little bit of a carbon tax in the US. But a carbon tax is not going to solve the problem of carbon emissions in the US. The carbon tax will probably just raise a little bit of revenue, but it's not going to solve the problem of carbon emissions, because I don't suspect that we're going to be willing to input a $300 to $500 to $700 per ton carbon tax, which would be what it would take to really achieve some of these big goals. I mean, net zero would require a carbon tax of that scale, essentially, in the US. Whereas companies seem to think they might be able to do it for a lot cheaper than that. Maybe they can. So I think we're going to run that experiment and see how it works first.
I guess going back to the question, I thought there was a Northeastern energy compact that was at least pricing their energy carbon emissions off the California market.
Yeah, so there was a Northeastern, a group of Northeastern states got together. That's sort of disappeared off the radar. And the RGGI, Regional Greenhouse Gas Initiative, some states have sort of fallen out of that. There's still remnants of that sort of exist, but it didn't have any of the teeth in it. It was sort of a cross-state thing. None of the states, I don't believe any of the states went so far as to have a carbon cap put in place like California did. So no individual states actually did that. However, some states, like New York, had a lot of regulations in place where they really pushed the energy sector to switch to natural gas quicker than it did in other places, and to switch to renewables. They have much more favorable renewable, I guess, energy standards that push companies to move into renewables before they move into other sorts of electricity and energy. So, many of those states have gone further down the road of sort of renewable energy standards than other states that are outside of RGGI, but they didn't go to sort of a full-on carbon market like California did.
Okay. Brent, I just wanted to throw in a very quick question to you. You gave us some prices for these voluntary markets, and we know what the prices look like on the California market in terms of the price of permits, and then what you're going to get for putting for storing carbon. I guess this is sort of a geeky environmental economics question. How do these prices compare with accepted estimates of the social cost of releasing a ton of carbon?
Well, they're all voluntary, right? So they're lower, right? So California's issue is that the trade price of carbon permits in California is somewhere around $30 a ton, which is higher than their trade price for forest-based offsets, which is $18 a ton. So they've kind of got two prices going, but even $30 per ton. So the social cost of carbon, according to the Interagency Working Group from the U.S. federal government, which probably has the best sort of estimates from a range of models and good analysis underlying those models, is I think $51 per ton right now. It's up for revision. It was supposed to be revised last winter. It hasn't quite come out yet as to what the revision is going to be. It'll probably be a little bit bigger than that, but maybe who knows how much. So that would be the social cost of carbon would be $50, and we're seeing most markets like California, because it's a limited market. It's just one state. It's not the entire country, right? It's at $30. Europe, actually, the European trading system has, if you're a carbon geek, it's a renaissance there. They're up at like something equivalent to $80 per ton carbon dioxide. So they're actually above what the social cost of carbon is. So they've implemented some more stringent regulations there. New Zealand's $25, $30 per ton in US dollars. So these voluntary markets are at 11. It's right what you would expect. It's a voluntary market, right? It's susceptible to free riders. Right. It could still go up and make it more costly for people to offset their carbon, but it's a voluntary market, and it's lower than what you would get if you had a regulatory market.
Okay, I kind of figured that's what you were going to say. So let's move on from that. We have a couple more questions in the.
You're trying to get me in trouble, man.
No. I think it's an interesting issue, just as an economist. So I have a question from an anonymous attendee. Then we have another question from Eric Romich. I'd like to get through those two questions, and then we're probably going to have to wrap up. So the question says, Professor Sonjan, I'm interested to know your thoughts on how the March 2022 SEC proposal that would require public companies to disclose environmental impacts and emissions and progress towards climate change goals. How would that proposal, how do you think it might impact the carbon offset market?
Yeah, that's a great question. That's an interesting one, because so this question of additionality, it wraps up this question of additionality. So I like to take the example of a forestry company. So say a large company, the largest landowner in the U.S., private landowner in the U.S. is Weyerhaeuser, which has something like 15 or 20 million acres of forest land in the U.S. They sequester carbon in those forests. On an annual basis, they're taking more carbon out of the atmosphere than they cut every year through their cutting of trees. That carbon, according to the Carbon Disclosure Project and any carbon accounting, could be used by Weyerhaeuser to offset their emissions from their basically wood processing mills, right? So they can become carbon neutral just based on their own land base and their own emissions from their power plants. So the SEC presumably is writing rules to allow companies, to require companies to disclose that kind of information, right? And so then the question is that if Weyerhaeuser can offset their emissions with what they do on their land base, right? And if that's true by SEC rules, through these new potential SEC rules, then should they also be allowed to then sell those offsets to somebody else? Right now, in current market structures, they're not allowed to sell those to somebody else because they don't meet this additionality test. So we have this additionality test that says that if you're going to sell a carbon credit, you have to be able to prove that it's something additional to what you would have done otherwise. Weyerhaeuser would have already sequestered that carbon because that's what they do. I mean, they're a tree growing company whose job is to sequester carbon in trees and then cut it down, obviously, but sequester more the next time around, right? So it's interesting that so what the SEC is unwittingly doing right now is they're creating a set of rules that's going to kind of throw this entire offset market into disarray because they've tried to impose these additionality rules, right? And now all of a sudden the SEC is going to sort of kind of create a back door around them, which I think is correct, actually. It's the correct way to go. The additionality rules, I think, are false. So I think it's actually a good thing. I think the SEC could probably help the situation in carbon markets, especially with additionality, rather than hurt it. So I think it's a good thing, and I think it'll help in the long run, as long as they get it right, I guess.
Okay, and then we have one last question in the Q&A. This is a relatively technical question from Eric Romick. I'm not sure how to pronounce your name, Eric, so I apologize for butchering it. So the question says, most LCOE, you'll have to translate that acronym for me, Brent, data I've reviewed from the US Department of Energy and the EIA reports the solar and storage cost that is based on a modeled 4-hour storage system. Eric then says, this is a little misleading as a 4-hour system is only going to help address small daily demand spikes in the absence of the renewable resource. Do you know if the LOCE that you Brent, that you reported for storage is modeled in a similar manner based on 4-hour storage? If so, how does this impact how much renewable generation we can incorporate while maintaining reliability?
Yeah, it's a great question. The Lazard study was targeting 6-hour storage systems, but also had some longer-term storage systems. So they had a range of costs. I sort of quoted that sort of $130 to $300, and within that set of costs, there were different storage links. So I can send Eric. I can send you the Lazard study. I think they targeted on average 6-hour storage rather than 4-hour storage. But that is a big issue, right? And trying to get it to longer term storage is really important for this exact issue that you raised.
Okay, so we've reached our time limit of 1 o'clock. I had a load more questions just in case, but we had plenty of questions in the Q&A. So first of all, I'd like to thank Brent very much for his very informative seminar, and you've got a few compliments already, Brent, in the Q&A. Joe Gleam says he really enjoyed your presentation, and then let me just look at the Maureen Cahill says in the chat box, thank you for the robust, informative, and delightful presentation. So I'll just use those 2 little quotes to say, and actually Eric Romick also says great talk, thanks to you, Brent. So I'll just back up what people who've been in the webinar today have been saying. Great presentation, Brent. Thanks so much for spending your time with us today. And thanks to everybody who was able to be on the webinar. That wraps up our current spring Outlook and Policy series. I'd like to thank everybody who's spoken in the series over the last few months. Just to let you know that coming up in September at the Farm Science Review, the department will be running a panel. That will be through the Ask the Expert series that Chris Brunius from OSU Extension will be moderating and running out at the Farm Science Review out there at Molly Caron in September. That'll be on the first day of the Farm Science Review, and there'll be a panel of folks from our department. We're also going to have we're going to be back in person, we hope, for our annual Outlook and Policy meeting. That'll be on November the 15th, more details to follow. And right now I know that Brent and the rest of us are planning to put together a new set of these kinds of webinars throughout the autumn semester with a view to getting folks in AEDE, the department, to talk about topics that they're interested in. So if you've enjoyed the series that we've been running since we started back in January, I think, with Zoe Plakias, and then we went through folks like myself, Seung-Ki Lee, Margaret Jodlowski, Mark Partridge, and then Brent. I don't think I've missed anybody. Oh, no, I don't think I've missed anybody out. So hopefully you've enjoyed the series. We're going to have some more speakers in the fall, and we have other in-person events for you. So with that, I'm going to wrap up the webinar for today and thank everybody for attending. Thanks very much. Take care. Have a great summer.